Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio since 1977. You can find more about my work on www.peterdack.com or on my blog, peterdack.blogspot.com. Today I'm going to talk to you about productivity. It's a very crucial, important concept if you are a serious investor. And the purpose of this presentation is to show you why. First, I would like to explain what the productivity is, how is it measured, then how it relates to trade deficits, to the cost of labor, labor cost, to profits of corporations, and of course how it relates to the stock market and to overall economic growth. And is the main mover, that's why it's such an important concept. How do you define productivity? Well, it's very simple. Let's say you are a shoemaker and you make one pair of shoes per day and you sell it that day and you sell it for $50. Let's assume now, because of some ideas you got, some machines you purchased, instead of one pair of shoes, you make two pair of shoes per day. Your income has grown to $100. So by improving your productivity, in other words, your output, for one day, you doubled your income. So your wealth has increased. So by being more efficient, you become wealthier. This is a very crucial concept. Again, let me repeat the idea that rising productivity is equal to rising income. So people get wealthy for many reasons, but the main reason is that they are very, very efficient and very, very productive. The bottom line is that productive countries, that is, countries that are very efficient and produce goods and service very efficiently, and people who are very efficient, work hard, highly educated, are wealthier than those with low productivity. This is a fact of life that people have to recognize and accept. This is the graph of productivity growth in the US. Notice how productivity growth increases, then it slows down. That is, we produce fewer and fewer shoes per day, so to speak, just to carry the example. Then here in 2009, productivity improved rapidly. And now look what happened since 2010. Productivity growth has been declining quite sharply. That is, we as a country have become less and less efficient. This is bad news because this growth is close to zero. And again, the slowdown in productivity means that we are becoming less productive. What is the impact of declining growth in productivity? Well, if it makes sense that when you become less efficient as a country, you export less because everything you do costs more, either that or is not high quality. And this is what happens. This is the graph of productivity growth with the red line. You see it slows down, then accelerate, and then again productivity slows down again, the red line. Look what happened to the trade balance. It keeps on going down because we are becoming less efficient. We are not producing enough goods that the markets, international markets want, and with a high quality at a low cost, because our productivity is coming down. We're becoming less efficient. It's more costly. Therefore, the trade deficit it become increasingly more negative. This is on the right hand side of the chart. Then we become more efficient, we produce better, we export more. But now look what happens here after 2010. This loss of productivity is reflected in our lack of capability of exporting goods that the international markets want with the quality and the cost that the international markets want. This graph shows, again, productivity is the red line, then increases and then slows down after 2010. But look what happened to labor cost. That's why productivity is so important. When we become more and more efficient, labor costs have less and less of an impact in what we produce, because corporations can absorb the increase in wages. However, when we become less efficient, our productivity growth declines. Look what happens to labor costs. The blue line is accelerating. So the labor costs are accelerating. Corporations therefore have to raise prices, which is the reason why the trade deficit increases, because our costs are increasing. So again, when we are very efficient, labor cost and the red line increases, then we can absorb labor cost and labor cost decline. But when productivity declines, then labor costs rise, and therefore the products that we produce become much more expensive. This graph shows the growth in productivity, the red line. Here there is the slowdown. Here we become much more efficient in 2009. Productivity grows very strongly, and here's the slowdown after 2010. And the blue line is profit, the growth in profits. If you notice, when the productivity is strong, profits improve, because with high productivity, corporations can absorb increases in cost. However, when we become less efficient, corporations cannot absorb the increase in cost, and therefore profits suffer and slow down. Then productivity improves again, corporations can absorb the increase in cost, profits increase, and this is the expansion. Now here, productivity slows down again after 2010, and sure enough, profits slow down again, because corporations cannot absorb the increase in cost. This graph shows, again, same thing, the growth in productivity, strong here. We're becoming slower growth, we become less efficient. We become more efficient here, productivity slows down again. And the blue line is the growth, the change in stock prices. Notice how when productivity improves and profits improve, and the stock market has a solid performance. This is growth in stock prices. However, when productivity slows down, profit slows down, and of course the stock market, which reflects the growth in profit, slows down. But then a year after 2008, productivity improved. If you recall, profits started accelerating again, and sure enough, the stock market grew very rapidly. Now, after 2010, productivity is almost close to zero, and profit, as we saw, are slowing down. And what happens to the stock market? The change in stock prices has been steadily coming down. This chart shows the growth in productivity, the red line. Here there is the slowdown from 2002 to 2009, then the acceleration in productivity, we are becoming more efficient, and then here the slowdown again after 2010. And look how the pattern, the blue line, is the growth in GDP, in other words, the growth of the economy. And look how the growth of the economy follows pretty closely the growth in productivity. In fact, the growth in productivity tends to lead a little bit, by a few months, the growth in the economy, because as we become more efficient, we produce goods faster, profits increase, and everything is much more dynamic. But look what happens here now after 2010. The growth in productivity is slowing down, and sure enough, the growth in the economy is also slowing down. So the point is that productivity is a major determinant of economic growth for all the reasons that I reviewed in the previous graphs. So what is the answer based on the graphs that I showed you before? Well, is that our wealth and wealth of our country depends on how productive and efficient we are. In other words, how fast our growth of the economy, our income, our profits, the stock market, it all depends how efficient we are. How can we become more efficient? There are many, many reasons, but definitely what I found that education has a major impact on the productivity of a country. You go in all the country that is highly productive, you will find that the people are extremely well educated and have an excellent school system. Thank you for following this presentation, and I sincerely hope that you found the concept that I explained in the previous slides useful for setting your investment strategy. Again, thank you, and I really hope to see you here really soon. So long.